Ladies and gentlemen, welcome to the Nubank earnings breakdown. The market is officially closed. Nubank closing out at $13.34. Let's go ahead and take a look at that, and then we will monitor some of the names here that are coming up for earnings today. Okay, so this should be very interesting. I'm looking at Mardo Libre. I'm looking at Block. I'm looking at Nubank. But only a shareholder in two of those now, Nubank and Mardo Libre, dropping the position of Block, which means they're going to have fantastic earnings because that's always what happens, right? You sell it, they do amazing, and then you move on. But I just don't believe in the story like I used to, comparatively to some of the other names that I'm end up holding. Like I think Nubank, for example, which doesn't necessarily jump pretty aggressively on earnings usually. But they have a very, very compelling long-term story that I want to see play out over 5 to potentially even 10 plus years of them going from 110 plus million users to 200 plus million and beyond, not only just in financial services, but in other products as well. So there's a couple things that we're going to be talking about throughout this earnings, different partnerships with interesting companies like even Burger King, for example, that Nubank is starting to do that are bringing additional member benefits way past just being a regular financial institution. Okay. They are the largest bank in Brazil. And there's a reason how, going from a real product launch in 2014 to now they have 110 plus million users, and that's because they're absolutely killing it. So throughout the course of this live stream, we're going to be following the numbers, but also covering, reasons for why I actually believe things are doing so well, hearing the earnings call, and going through all the emotions that we're going to feel during this long earnings call. By the way, I don't know if you guys follow Nubank or have heard in earnings from them. They are long. Okay, so this is another thing that I potentially, will consider doing during this time is not just plugging and listening to the numbers, because they're going to be doing a lot of that come 5 o'clock whenever the earnings are going to come out. So we're going to take it a little bit slower, cover Nubank, cover Block, and a bunch of other names while we actually do this. Okay. Just in the after hours, as we start to see numbers come out, let's keep an eye on things here. But Booking Holdings is now seeing a slight jump up in after hours, seeing roughly 3.8% up. Nubank is actually down just 1%, and Block is up 1%. So just sort of flat on both names. Let's go ahead and share my screen there. Mardo Libre up 12%. Wow. Okay, we have to check that out. Let's go ahead and jump over to Meli real quick, because there could be some very interesting things happening in this name. Let's see if numbers have been initially released. Let's see here. Meli. Does anyone have the numbers for Meli? Mardo Libre. This is the Amazon of Argentina, Brazil, Mexico. They're a very interesting name. Essentially, they have almost like a 2x beta on Amazon, and yet play in all those verticals, including financial services, where they have a consumer-facing fintech app that is doing quite well. So we'll keep an eye on that. Let's see what we can find here. I don't see the quarterly results on their website just yet. So potentially Bloomberg has received the numbers already, and we will wait. Let's check Earnings Hub really quick. Potentially they have an early release on the numbers. Block still holding up 1%. Nubank down 1.2%. Mercado Libre up 12. Expectations for Mercado Libre, $5.94 billion, EPS is $7.56. You have to keep in mind, although it's $7+ in EPS, the stock is 2,000 plus. So just keep that in mind whenever you try to compare that to potentially other names that you're looking at. Okay, sales came in at 6.1 billion versus 5.9 billion expected. Net income 640 million versus expectations of 400 million. Wow, that's crazy. Gross merchandise volume 14.5 billion, up 56% year over year. You have to factor in TPV 58.9 billion, up 49%. They are growing like gangbusters here. Let's see if we can actually get the report. Which one of you guys in the chat is Nubank down 8%? See, that's crazy. We have to see what those numbers are. This is why I didn't end up buying any during the crash down to 10, is because it's not like it was just expectations. There were material effects for there being problems with their currency. So we'll have to check what those exactly were. Members came in. We have the presentation for Nubank. We'll do a rough draft, but we're not going to stay on here too long because, like I said, they're going to show this off as well on their own. Members came in at 114.2 million, up 20.4 million users since last year, 58% of the adult population. That stays flat. Total deposits, 28.9 billion. Interest earning portfolio, 11.2 billion. Let's keep looking through here. Revenue, essentially flat quarter over quarter, down to 50% year over year. Gross profit, also flat, 46% margin, but that is still an insanely strong margin. But I know that people are wanting to get to that 50% number. There were some expectations last quarter that they were going to get to 49%. We're going to have to see why that is not recovering. And also, there's going to be some answers that just management is going to have to give us. One of the things that I'm worried about for wow, this is great clarity. Let's read this. Okay, win in Mexico, 10 million members in 2024, up 91% year over year, $4.5 billion in deposits. That's crazy how much higher that is from last quarter. 5.6 million credit card customers, up 70%. Wow. Okay, ramp up in secured lending. This is their payroll lending department, which they just absolutely dominate. The 9+ new agreements increases their total addressable market by 70%. And there's really no one that can even match their pricing because they go direct to the consumer, where essentially every existing bank has to find a middleman that takes a cut, which impacts their ability to price at the same rate that Nubank can, which is digital only, direct to consumer, super cheap. Let's see here. NPS 84, the best amongst Brazilian high-income customers. That's interesting comparatively to the, purple card that is offered to the general public, which is actually 90+. So that's very interesting that they have a little bit more competition for the ultra high net worth, obviously, because every single bank wants to compete with that, where Nubank really has dominated from, offering products and solutions that other people just haven't been able to, compare with. Captain Gaming, I'm not going to be looking at Rivian too much. They are up 2.8%, but we're going to be looking at Nubank, Block, and Mercado Libre for the most part. Over 1 million customers actively purchasing in our marketplace. This is how they branch out of just regular financial products, right? The money platform, Purple Pages is a big one, New Travel, their new Cell, which is actually them offering SIM cards, digital only, so eSIM, partnering with a Claro via an MVNO partnership. They are now getting into actually offering gigabytes worth of data for members and giving them a discount, as well as cash accounts that if you do have a SIM card with them, you can also see benefits there in terms of better rates in your cash accounts. Okay, Activity rate. This is the first time it's ever fallen in however many years I've been covering it. Now, we knew that this was going to be the case. Now, I'm actually a little bit surprised that the activity rate didn't fall from like 83.6 to 83.5 and seeing like more of a, because it's been a slow active draw up. I would have expected it is sort of stabilization. It can't continue to go up. You can't have an activity rate of 100 plus or anything ridiculous. 83% was already ridiculous as it was. These are revenue making products in the last month from users. Okay. So the rate in which this stays high is just unbelievable. So 83.1%, it's not bad, but obviously people would have expected whenever you get however many quarters in a row, like 16 plus of them just beating this over and over and over and over, that to see this would definitely pop out as being a little bit, not disappointing, but it is a number that people are going to pick at. Let's see here. Average monthly RPAC is now $10.70. That is a slight decrease, but mature cohorts is still at 25 plus. That's very good. Active customers using Nubank as their primary banking relationship, though, 61%. Stunning. Average amount of accounts per user also climbing 4.1. And now Nubank is seeing a massive recovery in their stock, down at 8%, $12 a share. Hopefully some of you guys potentially snag that, because that is now down to less than 4%. So we're seeing a recovery here, but the main clarity is going to come whenever management gets to answer questions. Now, there are a couple products that I want to see. Like for me, credit cards is going to be the big highlight here. So we have a lot of time though, so I'm going to, so you see the slight drawdown in monthly RPAC, which could be a couple things. One, that could, not only are they moving up market, but they're also moving down market. So you can end up getting user bases. They said anyone that's 7 plus, and I mean age 7 plus, can be a Nubank member. So that could potentially be something like this. This could be Brazilian macro dependent as well. Whenever you have 114 million users, if the economies there shift even slightly, it's a massive shift to your overall business whenever you have a financial relationship with 58% of the total population. Total portfolio seeing a slight drawdown to $20.7 billion. Credit cards making up for 28% growth, which actually, did grow Personal loans ended up growing quarter over quarter, $400 million worth. Credit cards took a slight decrease, which is not necessarily a problem. You can see that the personal loan segment now making up for 29%. It's actually more safe, but the credit cards make them a massive, massive amount of money. So that was one of my concerns going into this, is what percentage of their credit cards is now seeing, not a max, but having some pressures because of you're just actually reaching your total addressable market. You're seeing some saturation here. Soaring. So that's exactly the way that I see this. This, so far, what I'm seeing is this is Nubank at its finest. This is a company that their multiple has fallen severely, and they continue to execute and grow. Okay. What we're looking for is new customers coming on the platform, which leads to, more active customers, more revenue, better margins, and then going into new geographies and continuing this cycle until you've sort of transitioned every single member from traditional banks over to fintechs. And we're not even remotely close to that yet. Community banks, regional banks, mega banks still make up for the large majority of accounts that are opened or currently exist. Nubank's total addressable market to take those over is, massive. And look at this diversification here. I just wanted to highlight while we're on this page. Just as of 2 quarters ago, we just started getting money accounts for Colombia, now actually starting to make up for a decent percentage of their overall growth or of their overall deposit base here. So this is them, diversification at their best. Just a couple quarters even before what you see here. Mexico wasn't even on this list. Okay. Now, it's really starting to show that they can diversify just away from Brazil in general, and hopefully that is continued and shown over the course of everything that they show here. Net interest margin down to 17.7%. That is going to be the what do you call it? Bear case here. This is why it's selling off. I don't need to look too much further than a shrinking in net interest margin, even though it was expected to some degree. Cost per active customer is still designed to not go above $1. That is going to continue going forward. That's great. Gross profit, 45.6% margin. Slight growth quarter over quarter, but seeing sort of a flattening out from where we were last year. So year over year, great growth rates, but I wonder by the time we get to these Q2 numbers that if there's going to be some harsher, comps for them to continue on. Holy crap. Their efficiency ratio is below 30% now, 29.9%. That must be a freaking world record. Like, that is insane. They are the most efficient freaking business in terms of financial solutions. So they continue to get better and better and better. But look how fast this happened. Okay. In Q4 of 2021, they had a 75.8% efficiency ratio, which is like really normal. There are a lot of banks that hold up in these ranges. 65%, you start to see the really, really tight banks that start to promote a 65.6% or 60% range. Then as it continued and we started getting sub 40, it just got ridiculous. And the fact that they're now sub 30% is mind-blowing. Okay, so that is crazy. That's absolutely crazy. All right, here, net income, $552.6 million. Like I said, these comps are going to start getting harder and harder. You're not going to see these 85% growth rates unless they can potentially pick up their credit card business in Mexico or start to diversify and continue that growth. But they are being punished by their own success, growing just insanely quick. But look at this. Wow. Okay. Not only did 15 to 90 day non-performing loans and 90 plus day non-performing loans, they both ended up getting a little bit better. So you end up seeing from Q3, which might be the top, 7.2%, now falling to 7%. That's going to get some analysts pretty excited, because if they can bring this trend back down to a normalized rate, that, it'll be easier for them to model, a normalized long-term losses on some of these loans rather than, if you start to see these uptrends that don't necessarily stop, you can kind of continue to project out, and your models can get pretty nasty if you think that this is going to go to 9, 10, 11%. Okay, let's see here. Fractionless renegotiation. Okay, cool. So this is them with a lot of their loans. If they are falling out of favor, what can we do to get you back on track to start paying these these balances? This is very cool. Okay, let's see what else we can find for the company. I also want to bring up some other stocks as well. I don't want to forget about Block, down 8%, by the way. Numbers have come out, down 8%. Mardo Libre up 14%, hitting $24.20. $2,420 a share. That's a fun one, isn't it? Anytime you want to just DCA a little bit into Mardo Libre, you gotta expense quite the capital just to buy a single share. But fractional shares and everything has kind of made this a little bit easier, and that's probably changed any sort of reason for them to do a stock split, unless of course that was in their earnings, which we just haven't read yet, if they are going to do a stock split, for example. Let's head back up to revenue really quickly. So in terms of expectations for Nubank, expectations had missed on the revenue side and EPS side. Let's see if they have it here, or else we can just calculate it on their here. Let's see. Do they have outstanding shares on their presentation, or will I have to go to earnings release here? Bear with me. Okay, I have their. I cannot wait for the earnings call. I'm going to start plugging all the numbers into the spreadsheet, and so 40 cents, 40.3 cents of EPS, beating a consensus of 12 cents, but on the revenue, it missed from 3.2 billion down to just sub 3 billion. So, massive disconnect on that side from what Wall Street was expecting. I didn't even do expectations for Nubank because I was quite busy this week. So, which, by the way, guys, I can't wait to tell you about the event at Shift 4. It was very exciting. I got to speak with a lot of the people at Shift 4, but mainly the strategy team, which is really the people that are responsible for a lot of the M&A deals like Global Blue. Super excited about that company, and I think that the market is just like misunderstanding it. However, I have a freaking super exciting interview tomorrow with a very exciting Wall Street analyst that covers Shift 4 that we'll have to see, what their opinions are and everything like this. Because literally, I was the only person in that entire room. Well, aside from two other retail people that were there, that was just all Wall Street analysts. It was just, a great place for me to learn to see how they end up looking at this company. But even they, like I was talking to a lot of them, they weren't even disappointed in the numbers. They just said, you know what, expectations kind of got brought up really freaking high for what they ended up showing in that quarter. But long-term guidance was something that we need to talk about as well going forward. Okay. Really quick, do we want to go through Block's numbers? Let's see if we can get Block stock here. Now, I have not looked at their expectations. We can do that midway through here, but let's see. Okay, let's go through their presentation really quickly because I am interested to learn about one of the largest fintech companies in the world. It's just Our oh, Yevgenis is very funny. I guess he found something in XYZ's report here. Let's go through this and see what we can find. Okay, gross profit of $2.3 billion, up 14%. Cash App up only 16%, and Square up 12%. See, this is one of the things that sort of has caught me by surprise with Block is just the slowing of growth in Cash App, and especially the gross profit growth in on Cash App side. Okay, that was one of the things that they continued to do. They said that they wanted to, not just start to bring people on for their, how much they're actually, making from like a transaction side, like on the payment side, but also start to bank them, like bring in direct deposits, start to bring in a lot of those things to have stickier users that have much higher revenues per active customer. So let's go ahead. I'm actually not looking at the screen that you guys were looking at. I was looking over here. So really quick, this is exactly what I'm talking about. Bank our base, right? So start to bring on, more new products, more lending products, direct deposit, and hopefully that increases the gross profit per user and drives more gross profit, which there actually was a big uptick quarter over quarter versus what we saw from Q2 to Q3 on the Cash App side, which was, in my opinion, a little bit disappointing. But you can see the growth rates here of what they were doing year over year. 25% growth rates, 25, 23, 21, and now 16, which is quite the fall off on a year-over-year basis. But it's harder to continuously have these average revenue per user counts continue to climb up. And if you can't have the average revenue per user counts climb up, then you have to have, monthly active, or like monthly active gross profit go up. So if this ends up staying flat, then it's a little bit harder, right? Inflows per active, that's very good to see over the last 2 quarters, starting to continue to really tick up. 10% growth year over year, up from last quarter of 9% year over year. Cash App Card active growth. I mean, this is the problem. This is still, they cannot increase their active counts at all. Still monthly accounts at 57 million. That's been flat for a full year. This company is throwing a ton of money into sales and marketing. Let's see if we can find sales and marketing. How did they write it? Here. Okay, maybe it's in the press release. Let's find sales and marketing here. Because they throw a ton of money at sales and marketing, and then if they can't show that the user bases end up growing on the active side, that means people are leaving, so potentially they're not as sticky. And or they're trying to get them into other products, but if you're not seeing it on the gross profit side, then what are you doing? What are you spending your time doing? So yeah, I mean, they're spending a ton of money, like $500 million on sales and marketing to show what? What? Now, I saw a post about this on their openness. Can we find this? Maybe this is in their press release. This is one of the things that I think people struggle with holding Block is some of their, wants as a company. They are developers through and through. And so, they look for, here it is. Like, as shareholders, what we're looking for is a very profitable company that makes a ton of money. And hopefully, as time goes on, they can, essentially start to bring those shareholder returns back to the investor. Whenever you start to see things like this can be a little bit disappointing from a shareholder perspective. Our product goals in 2025 and beyond are increased access to the global economy for everyone. Okay, pause. Cash App was active in other countries like Spain, for example. And they were trying to go global for a bit and then completely pulled back from all of that. So they stopped Cash App. I think it was in 4 different countries. Now I think it's only in 1 again, which is the United States. And they pulled away from their global aspirations. So in 2025, are you going back to that because you realize that the internal growth rates are potentially worse than expected? I'll have to listen to the call. So I'm making some assumptions here, but anyway, increase openness to earn trust and maximize customer flexibility. Increase openness. Interesting. Increase automation to remove mechanical burdens that get in the way of creativity. Well, I mean, every single company should be looking to do something along those lines in terms of automation. But the increased access to global economies for everyone, I want to see how that actually materializes. And then increase openness to earn trust and maximize customer flexibility. Okay. Our strategy is to bring our ecosystems together with a focus on neighborhoods. Block by block, we'll begin a new neighborhood network that connects sellers, buyers, staff, and artists, each positively reinforcing the other. Square and Cash App are already stitched into the fabric of local communities. So personally, this is another thing that I also have had problems with, and it's the reason why I don't invest in these craft-like businesses, is I just simply don't believe in the profitability. I'm not talking about from a community standpoint, from a moral standpoint, from whatever. I'm talking about profitability, okay? Betting on really, really localized products, or sort of like craft, or handmade. Like I just those. You need economies of scale, okay? And going neighborhood by neighborhood is not, there's no economies of scale there. So this is another reason why I'm just not a big block guy anymore, is because I feel like their focus is really on the dual-sided network piece, and they've hyper focused in on that to the point where they've realized the only way to make this work is to attach the really, really small merchants that they have, because they are growing up scale, but it's not fast enough. Comparing and trying to attach that to the Cash App user base. I find that the companies that are focusing more just on getting the bigger names like Shift4 and Shopify and Adyen are doing so much better at doing this without needing these sort of neighborhood networks. And then even, Shopify, for example, can put out products that you could still shop locally and everything, but they're not quite hyper focused in on this, which might make for a really sticky user base, but the growth rate might go down severely. Okay, just really quickly on Block, and then we'll head back to Nubank and Mercado Libre for sure. Actually, we need to go through Mercado Libre's before we continue on. To accelerate Square's GPV growth, which is their seller side, we're rapidly scaling up our U.S. account executive and field sales teams, expanding our international sales presence, and making partnerships across vertical, horizontal, and traditional payment partnerships. We increased marketing spend sufficiently in the second half of 2024 and saw strong return on investment on that spend, which will continue to increase to gain market share in our target verticals at a faster rate. This includes winning more upmarket sellers, such as Bluestone Lane, a coffee shop with over 60 plus locations across the United States. It is one good thing that Square is starting to see some growth again. This was not the case whenever Jack Dorsey fired, what was her name? It wasn't Amelia. They fired their old Square seller CEO, and Jack ended up having to take it over. But that's also not a good thing. You don't want to that slowed production for the business for sure. It was hiring people that potentially didn't see the vision that the CEO potentially saw. Okay, let's go ahead and take a look at Melee. All right. Which they did end up doing a triple beat both on sales, EPS, and forward looking as well. Okay, gross merchandise volume. So for the people that don't follow this company, they are Amazon of Latin America. And by the way, the stock is up 14.4%. So for those that are saying, I'm not interested in this, let's talk more about Nubank. It is good that if you are investing in Latin America, you need to know the giants that are playing a part in these industries, okay? The two that you want to pay attention to are Nubank and Mercado Libre. Those are the two that I hold. Some people say Inner is good. Some people say Stone Co. Whatever, okay? I'm focused on these two. I don't need Pogs, okay? I need Melly and I need Nubank. And I've been holding this company a very long time and do not focus on it too extensively, because all you need to do is just buy and... Oh, can I see the full chart, please? Can we can I look back like the last 10 years? Please? Nope, I guess not. Anyway, the company has done very, very well and will continue to do so. Okay? And yes, it did see some pandemic-related massive spikes and then into quite the sell-off. But if you've been able to accumulate anywhere from the 600 plus ranges, you're a very happy camper. And this is looking like it's going to just continue over and over and over. Let's talk about the business and see what we can find here. So one, they have their marketplace, which is the Amazon.com. This is the actual MercadoLibre.com. Unique buyers, they have 67.3 million. Now, that's very high for a couple of reasons. One, holiday spend, but also, potential like growth here. You can see unique buyers actually grew 24% year over year. They play in a bunch of different, regions, but Argentina is by far their largest. And you can see how fast the growth is there. Mexico, Brazil, all sorts of places growing very nicely on the marketplace side. Same day and next day shipments. They're building out their logistics side. This continues to get better. And actually, what I found very cool was they have an option where the shipping costs can get super low if you do a slow delivery. This was super interesting whenever I was starting to learn about Mercado Libre's slow shipping, where they can fill a lot of their demand or like a lot of their logistic. How do you say it? Like, where there's spikes up in demand and they are sort of oversold for those days, they can end up pushing other people's packages back to days where they are not as fully filled and start to like even out that demand to have not massive costs on their delivery. And this has seen unbelievable success. So it's very, very cool. Can't wait to hear this earnings call as well. Then we have Mercado Pago. Okay, this is their fintech solutions. They do what Nubank does. They've got a sort of app to allow for deposits to come in, spend, everything like this. It's at a very basic level compared to Nubank that hyper focuses just on that solution. But even then, you still have 61.2 million monthly active users. Okay, very, very cool. They're massive. They play in Argentina, Brazil. People love Mercado Pago. And, you can see how much their credit portfolio has continued to grow. Wow. Assets under management, freaking 10.5 billion, up from 8 billion a quarter before, 129% growth rate year over year. So this fintech side for them is growing very strong. Guys, don't worry, by the way. What's it called? Nubank's earnings are coming up shortly. Oh, you guys are talking about Celsius. Yeah, Celsius fell after earnings all the way down to $22 a share, and now it's up 18%. I'll have to check that out as well. That'd be very interesting to see. I haven't been following it over the last couple of quarters. But yeah, wow, 30.7 up 20% now. That's continuing even higher. Wow. All right, let's start to continue on here. Okay, yeah, they have growth in acquiring. They do both on their marketplace and off their marketplace as well. So one of the things that's interesting about Mercado Pago is the actual ability for them to do Mercado Pago for Mercado Libre, which is sort of that dual-sided network. Very, very interesting stuff. But yeah, so let's see here. Did they not show? Well, I guess they showed their credit inside of that. Did they show their logistics? No, eh? No, okay. Because they have an entire credit business, logistics business, marketplace business. They have all these different things. The one thing that I hate about Mercado Libre, which is being very nitpicky, is how much they actually change their earnings results every single quarter. They want to show off different highlights to their business, which can obviously change how you're looking at the business, which is actually good if you're not a freak with numbers like me and you just want a consistent linear numbers to follow. But for them, they add a ton of new clarity into all their different business lines that they're in, but very sporadically, almost like Cash App does. Yeah. So what's it called? Mercado Libre doing very, very good things. You can kind of see here broken out on a year over year basis, just how they're doing both financial services, all their fintech stuff, and then their commerce stuff, which is Mercado Libre and then Mercado Pago. Very, very interesting and a great fact sheet right here to look at all the growth rates and then the numbers for them as well. Holy crap. Holy. Okay, do we want to take a look at Celsius before we jump back into Nubank's numbers really quick? Let's see what the fuss is about. And why it potentially sunk early on. So revenue ended up beating by 1.58%, and EPS ended up beating by 40%. So expectations were 10 cents of EPS. They ended up showing 14 cents. Let's see if these are one-time metrics or if they are better efficiencies. Like I said, I do not follow this company. I know that the main thing is their partnership with Pepsi, which ends up getting the mass amount of their distribution, but I don't follow them in terms of where their gross margins were last quarter, for example, or how much more efficient they end up getting. Potentially, maybe they have that in terms of a chart that we can follow. Wait, is this a thing? Does Celsius own Alani, or did they just buy Alani now? This is probably announcing. This is probably announcing the purchase of it. Yeah, acquisition of Alani. That is crazy. That's crazy. I wonder how much this was for. Well, this is what the transaction overview is for. So let's take a look. For $1.8 billion with a mix of cash and stock, including a potential $25 million earnout based on the 2025 performance. Okay, cool. The purchase price is comprised of $1.275 million of cash and 500 million, about 22.5 million shares of newly issued Celsius stock, which kind of sucks because the price is so freaking low right now. I mean, you couldn't have made this offer whenever you were $90 a share. But that's fine. Alani is one of the fastest growing energy drink companies. In fact, if you were to go into my fridge right now, we have no Celsius. I think there's actually Alani in there right now because we buy whichever of the brands is, cheaper or new flavors that end up in Costco, really. But yeah, health-based energy drinks are the future. And now potentially what they're going to end up showing here is that Alani is potentially going to see some benefits from the existing distribution partners that Celsius has already made for themselves, and vice versa. That is very interesting. Combine two growing scaled energy brands with clear category tailwinds. Wow. Yeah, we don't have Ghost here. I know a lot of people have talked about Ghost. We don't have that here. We have C4. We've got Rain, Nos, Monster. But a lot of people talking about Ghost, and I've never had one. Yeah, Alani is very female focused. Centered around community empowerment and wellness for young women. Very interesting. Yeah, that was a definite massive acquisition whenever you consider the fact that, Celsius right now at the close was a $6 billion company, and they did a $1.8 billion acquisition. Attractive valuation representing less than 3x Alani's 2024 actual revenue. Wow. Wow. I think they both end up seeing the potential benefits of selling together. Okay, let's get ready for Nubank and take a look at the stocks that are moving right now. We have Mardo Libre up 12.4%, or $2,372. Block down 7% to $77 a share. Nubank down 7% to $12.42. The interesting thing that I find between Block and Nubank both falling, sort of in equal pace, is that I don't know if potentially my bullishness will ever change on Nubank. It certainly doesn't feel like that. But I am much more bullish on the opportunities that Nubank has ahead of itself for them than what Block does. It's a much easier story for me to understand. The potential for competition is so much lighter. The potential to grow up market is so much easier. It's incredible. Now, I would like some information on Nubank for, let's take a look here. If we can find some SMB information, potentially just getting a little nitpicky. Doesn't seem to be. I tried searching for it, but let's read through some of what they end up having here. So Nubank added 4.5 million new customers. That's essentially the entire size of Lending Club in one quarter. And increased by 20.4 million users, or essentially 2 SoFis in a year, reaching 114.2 million customers. This expansion further reinforces Nu's position as one of the world's largest and fastest growing digital financial services platforms. In Brazil, Nu has already become the third largest financial institution by number of customers. Net income, we read a lot of this. I want to go to more of the loan to deposit ratio stood at 39%. That is hilarious. There are some institutions in Brazil that bring that as high as 80, 90+%. If Nubank was to do that, think about the how large their actual lending portfolio would be, let alone the fact that it's already expanding 45% year over year, 13% quarter over quarter. Okay. Nu's asset quality leading indicator. We read that as well. They both fell on a 15 to 90 day basis and on a 90+ day basis as well. Let's find some of the more interesting stuff here, though. I want to find purchase volume. That's interesting. Year over year, a little bit lighter. I wonder why that is, that the purchase volume, although you're seeing such high amounts of active customers, that you're not seeing that in the purchase volume. I'd love to know that. Monthly active revenue on a year-over-year basis went up, but not on a quarter-over-quarter basis, which is this sort of segment right here. Okay, let's find out. Deposits still growing strong and seeing a lot of diversification amongst their other things, their other geographies. Revenue and net income sort of staying flat quarter over quarter, but not year over year, continuing to grow. But yeah. Let's find out here. Mexico surpassed the milestone of 10 million customers. Colombia reaching 2.5 million. What else? Let's find out what their... do we have... Yeah, searching for credit card on Nubank's thing is not going to yield us the results that we're looking for. But I just like the actual product numbers. Like, they will give us these numbers on... Actually, did they release that yet? This might actually be out already. Here, wait, let's... Oh, it is. Great. Okay, here. This will be a lot of fun. Let's take a look at Nubank on more of a number basis. Now, the only problem with this is that you're not going to see any charts from me. I have to plug this into my own spreadsheets where I can pull my own KPIs, charts, everything like this. But it'll give us uh, some indication of how they're doing. So operating figures as well. This is interesting. So here, can I find out? I'll just zoom this way. Number of customers in Brazil, 101.8 million. Mexico, 10 million. Colombia, 2.5 million. You can see what that did quarter over quarter. Okay. Colombia actually growing 500,000 more members. Crazy. Number of active customers in Brazil. And then across the board here, these are all the Brazilian numbers. You can see here, Brazil only. This is the problem with this, is that we don't actually get to see the numbers broken down for the other businesses. Okay, but let's still take a look. New accounts, 78.5 million. Credit cards, actually seeing good growth here on credit cards, both consumer and their PJ account, which is their the business side. You're actually seeing there was a slowdown quarter over quarter last time, 38.1 to 38. So that was a little bit concerning. Now seeing 40.1. Those problems are sort of. I'm sorry, I was hearing a noise that I wasn't expecting. So that's now growing again. The PIX transactions, this is still going well, and financing under PIX. Unsecured credit growing. Insurance policies growing quite a lot, actually. Still holding up the 200,000 growth rate. And that is just for Brazil. So hopefully once that expands to Mexico and Colombia, that continues to grow as well. The investment side. So this is where people start to think, okay, well, how will Robinhood, or how will SoFi sort of venture, like if they end up getting into Latin America or going after Brazil because the markets are just so large, how will they fare in these areas? Well, this is where I want to take a look at, their investment customers are just growing. That's 2 million new investment customers in Brazil alone. 200,000 new SME accounts, which is their small to mid-sized enterprises. Total payment volume doing very well, both on a credit card side and the prepaid card, which is really starting to grow now because, it's less credit for them to end up underwriting for the really low, like whenever you're working down market, you need a product for them as well. Number of customers doing fine. Let's see here. Call is in 6 minutes. I'll have that up. Let me make sure that I'm ready on that front as well. Okay. Average revenue per customer has been falling just a little bit over the course of the year. So we'll have to hear what that's about. If it's them working down market, or what the sort of story is there. If it's having to do with their credit portfolio, we'll have to see. This is their card portfolio breakdown. Let's see here. Yeah, installments with interest is such an interesting story for Nubank over the last little bit, considering the growth in current or even revolving is not quite the story that installments with interest have sort of taken over, which is very interesting. Their non-performing loans or where they can lose out on their portfolios are doing a little bit better. Let's see here. Total write-offs. Well, this is quite interesting. I wonder if they'll have to cover this. In Q4, there's a definite spike up, but the numbers are just getting so freaking large here now. Okay, let's continue on. Yeah, I'll have to plug in all these numbers so then I can actually see the customer acquisition costs and everything. I don't think if they showed that off or not this quarter, but yeah, I'll want to see that. Interchange fees are really high on their earned revenue, considering the fact that their last quarter they actually saw a little bit lower in terms of purchase volume. I wonder, hopefully they give us some more clarity on that in the call. All right, let's do some quick questions actually, and then I'll get the call up here. Currently, the stock is still down 7.5%, Block down 6.3%, Mercado Libre up 12%, Celsius up 29% in the after hours. 29. They stopped reporting customer acquisition costs. That doesn't matter. I can still pull it from their sales and marketing and then how many new ads that they actually have. How's Celsius? I took a quick glance at it. I mean, I barely even looked at any of the revenue growth rates or anything. I just found out the Alani deal, which I thought was quite interesting. And maybe that was already known. I really don't follow the company, but that's interesting to me. Hopefully the market has a green day tomorrow. It's took a beating. Mercado Libre is overvalued. Oh, buddy. I think people are really valuing how much they've already like the long-term success of them, sort of executing for decade plus, right? Like they just aren't stopping. And that's the thing. Like Amazon's actually having a really hard time entering these markets. You see a couple fintechs that have tried to go sort of towards Argentina that have had been not so successful because Mercado Pago is very strong there. Nubank is a formidable opponent, though, if they ever got into Argentina, which might happen in the next little bit. And hopefully we hear some more information on that in the call in terms of their aspirations to get into Argentina and even the United States, which I think they're going to enter both over the next 18 to 24 months. Can't wait to hear about Shift 410. Yeah, I've got a lot to say. That was very, very exciting. I think that the stock sort of took an unwarranted hit on that, and I'm probably going to add to my position because I think talking with Taylor and Jared and everything, they are so confident about what the mission is, and Jared's not leaving. Like he's got other things, but he's kind of been playing a very strong advisory role for a very long time, and he said he has no reason to not continue to be an advisor on the really, really large deals that they want to end up doing. But with the acquisition of Global Blue, the prospects going forward is very interesting. Okay, and if anyone caught the earnings call, the unified commerce, that I really want to talk about that. Anyway, let's see here. It's because of foreign exchange. Yeah, I mean, this is the thing with Nubank is, and the reason why I didn't add whenever it was like down at $10 is the reason why the market was selling off is because there was real macro problems. It's not like everything is a buy the dip situation. There could be real financial impacts to a potential weak dollar that if you are looking at it on a foreign exchange neutral basis, they are going to be heavily impacted on, how much they end up growing. So the call should be starting. I have it open. They do it on Zoom, which sucks. I don't know why they do that. They should put it on YouTube or X or something, but or like Q4 or whatever that company is called. But no, they do it on Zoom. But yeah, it says The call will start soon. Okay, let's see if potentially I can join from my browser. That would be even better if I could do that. It says, please wait. The webinar will begin shortly. You still don't see Nubank numbers? It's an hour ago. Now we're just waiting on the on the call. And hopefully we have that guy that does the visual, or not visually impaired. They have a guy that does the American sign language. American sound language. It's kind of what it is, I guess. Yeah, what's the play with Nubank? I buy and hold companies. That's my strategy for every stock that I get into. I think warranted that there's not some thing that they talk about on this call here in terms of their brand is somehow getting worse. If the brand is staying strong, Davi Velez sees opportunities that are outside of financial services, growth in dual-sided networks, a credit portfolio is growing, entry into new geographies. Like, I've got zero reason to believe. Okay, call is starting. Call is starting.
Good evening, ladies and gentlemen. Welcome to Nu Holdings conference call to discuss the results for the fourth quarter and full year 2024. A slide presentation accompanies today's webcast, which is available on Nu's Investor Relations website, www.investors.nu in English and www.investidores.nu in Portuguese. This conference is being recorded and the replay can also be accessed on the company's IR website. This call is also available in Portuguese. To access it, press the globe icon on the lower right side of your Zoom screen, then select the Portuguese room. After that, select Mute Original Audio. Para acessar nossa conferência em português, clique no ícone do globo ao lado inferior direito da sua tela Zoom e selecione a opção Portuguese Room. Ao acessar a nova sala, certifique-se de mutar o áudio original. Please be advised that all participants will be in listen-only mode. You may submit online questions at any time today using the Q&A box on the webcast. I would now like to turn the call over to Mr. Jörg Friedemann, Investor Relations Officer at Nu Holdings. Mr. Friedemann, you may proceed.
Thank you, operator, and thank you everyone for joining our earnings call today. If you have not seen our earnings release already, a copy is posted in the Results Center section of our Investor Relations website. With me on today's call are Davi Velez, our founder, Chief Executive Officer, and Chairman, Youssef Lahrech, President and Chief Operating I would also like to remind everyone that today's discussions might include forward-looking statements, which are not guarantees of future performance and therefore
Can you guys hear it?
you should not put undue reliance on them. These statements are subject to numerous risks and uncertainties and could cause actual results
Zoom
to
sucks,
differ
man.
materially
I'm glad the call didn't start
from
yet.
our expectations. Please refer to the forward-looking statements disclosure in our earnings release. Today, Davi will discuss the main highlights of our fourth quarter and full year 2024 results. After that, Lago and Youssef will take you through our financial and operating results in more details. We will then open the call for questions. I will now turn the call over to Davi. Please, Davi, go ahead. Thank you.
Thank you, Jorg. Good evening, everyone, and thank you for joining us today. 2024 was another pivotal year in our strategy as we continue advancing in our mission to fight complexity and empower people. Our consistent execution and customer-centric approach drove significant growth across all three geographies. We now serve over 114 million customers with 20.4 million net addition this year alone. Our active customer base grew 22% year over year to nearly 95 million. In Brazil, we continued adding over 1 million customers per month, serving 58% of the population and further consolidating our position as the third largest financial institution in the country in number of customers. In Mexico, we achieved a significant milestone by surpassing 10 million customers, underscoring our strong growth momentum in the country. Beyond customer growth, we strengthened our deposit franchise, particularly in Mexico and Colombia, a crucial step in reinforcing our long-term strategy, bolstering our liquidity position, and enabling prudent credit expansion. Total deposits grew 55% FX neutral to $28.9 billion, while our interest-earning portfolio expanded 75% to $11.2 billion, also on an FX neutral basis. We have maintained our high growth trajectory while significantly strengthening our financial results, demonstrating the efficiency and compounding power of our business model. Revenues grew 58% year over year on an FX neutral basis to $11.5 billion in 2024, driven by sustained ARPAC growth, up 23% year over year in FX neutral terms to $10.7. Our efficiency ratio improved further, dropping below the 30% mark to end the year at 29.9%, making Nu one of the most efficient global financial services platforms, and with room for additional optimization. Notably, net income almost doubled from 2023 to close to $2 billion, with an annualized return on equity of 28%. These results place us among the most profitable financial institutions globally, even while maintaining a significant excess capital position at the holding level. These achievements underscore the power of our low-cost financial model, our commitment to customer engagement, and our ability to deliver sustained profitability at scale. With a strong foundation in place, we remain focused on extending our market leadership, launching new products, and deepening financial inclusion across Latin America. Now, let's move on to the next slide to take a closer look at how we advance on our strategic priorities in 2024. First, in Mexico, we reached an exciting milestone of 10 million customers, up 91% year over year, now serving 12% of the country's adult population. Deposits grew significantly, increasing 438% from 2023 to $4.5 billion, reflecting our position as a trusted financial institution. Our credit card customer base expanded by 70% to 5.6 million, and almost half of these customers did not have any credit card before ours, demonstrating our ability to help increase financial inclusion in the region. Over the last 3 years, our first payment default rate has improved by approximately 50%, while credit approval rates in Mexico have increased by 10%, underscoring the significant enhancements in our risk models and their impact on both credit performance and accessibility. We also expanded cash-in and cash-out access to over 30,000 contact points, a critical component of our long-term strategy to digitize and democratize financial services. Now moving to secure lending in Brazil. This portfolio grew an impressive 615% year over year to $1.4 billion, representing 23% of our total lending portfolio. We signed 9 new agreements with collateral counterparties in the public sector, expanding our total addressable market for payroll loans to 70% of the segment. As a result, 12 million of our customers are now eligible for payroll loans, along with an additional 80 million for FGTS loans. We also enhanced our portability solution and features, and as of December 2024, 16% of INSS originations came from customers who brought their loans to Nubank and refinanced them under better conditions. At the same time, we captured over 30% market share in FGTS originations, underscoring our strategy's success and product market fit, as well as the power of our low-cost distribution model. Building on our success in Brazil, we made significant strides with our high-income strategy, expanding our reach with close to 700,000 Ultravioleta customers, a 132% year-over-year increase. Credit card performance was also remarkable, with quarterly purchase volume from Ultravioleta credit cards increasing 106% year-over-year to $1.8 billion in Q4, and accounting for 10% of our Brazilian credit card purchase volume. Our NPS of 84 continues to set us apart as the most loved brand among high-income customers, alongside a 16% increase in brand consideration. Finally, our money platform is becoming a bigger reality. Nu Marketplace had over 1 million customers shopping on our platform throughout the year. We also launched Nu Travel, enabling customers to plan their trips seamlessly and securely within the app, with the guarantee of the best price, bundled with a multi-currency account for even greater convenience. And in an exciting development, we introduced Nu Cell, our MVNO service in partnership with Claro, further diversifying our offerings, strengthening Nu's ecosystem, and expanding our addressable market. As we continue making progress in our 3 geos, we remain very excited about the exciting opportunities we have ahead by expanding Nu's platform, increasing the market share of our core products, and further monetizing our existing customer base. Additionally, capturing growth in new verticals with our money platform strategy is gaining traction, significantly broadening our total addressable market. The strategic expansion of our ecosystem has continued with the launch of Nu Cell in Brazil's massive telecom services market and the build-out of Nu Marketplace. What's particularly exciting is that these are entirely new and significant avenues of growth for us, along with Nu Travel and Nu Pay. Reflecting on 2024, we're very pleased with the progress we've made across our strategic priorities, and we see several early indicators confirming that we remain on the right path. Nevertheless, our perspective is that it's still just day one. We remain focused, ambitious, and excited about what's ahead. And with that, I'd like to pass the floor to our CFO, Guilherme Lago, who will walk us through the details of our financial results. Over to you, Lago.
Thank you, Davi. Good evening, everyone. As Davi noted, 2024 was an exceptional year, marked by strong and consistent revenue growth, deeper customer engagement, combined with solid operating margins and profitability, all of which further validate the power and efficiency of our business model. Let's take a closer look at our fourth quarter results and how we have continued advancing across the key pillars of our strategy. Beginning with customer acquisition, we saw another quarter of strong growth, adding 4.5 million new customers to our platform and ending the year with 114.2 million customers, a 22% increase over 2023. As our customer base continues to expand, our focus shifts increasingly towards engagement and retention. Our active customer base also grew by 22% year-over-year, with our monthly activity rate reaching 83.1%. Please note that activity dynamics in Mexico and Colombia differ from Brazil's, as we refine our product offering in these 2 important markets. While customer growth in Mexico and Colombia outpaced Brazil this quarter, initially lower activity levels in these 2 countries temporarily impacted our consolidated activity rate. Turning to revenue expansion, as shown on the first chart on slide 10, Nu continues strengthening primary banking relationships, now representing approximately 61% of our active customer base. This strong performance underscores our ability to capture a larger share of wallet through effective cross-selling and upselling, further reinforcing our position as our customers' primary financial partner. We are also very pleased to see that recent cohorts are reaching this level of primary relationship at an accelerated pace. The chart in the center shows that the average number of products per active customer has now reached 4.1, also demonstrating the success of our cross-selling strategy, even as we continue welcoming a growing number of new customers. By effectively introducing our products to these new customers, we deepen engagement and further strengthen our role as their main banking partner. The last chart illustrates the combined impact of these two powerful dynamics: best-in-class customer engagement, coupled with our growing cross-sell capabilities, enables increasingly positive results. While our average monthly RPAC stands at approximately $10.7, our more mature cohorts are already reaching $25, demonstrating the strong long-term monetization potential of our model. Please note that the RPAC dynamics shown in this slide also reflects the accelerated growth of our customer bases in Mexico and more recently also in Colombia. While our deposit strategy in this market may initially attract more customers who engage primarily with the Cuenta product, one that generates relatively lower RPAC levels, we are highly confident in the long-term value of this approach. As we have seen in Brazil for nearly a decade now, this strategy lays the foundation for deeper engagement and greater monetization down the road. As depicted in the left-hand chart, our monthly RPAC experienced a slight decline of 3 cents. However, on an FX-neutral basis, it expanded 5% sequentially and 23% compared to the prior year, despite rapid customer growth in the new geographies, as I mentioned before. Again, we remain confident in our ability to continue increasing RPAC to its full potential as our customer base matures with time. The chart on the right shows revenues hit another record high this quarter of nearly $3 billion, up by 50% year over year. This remarkable growth was driven by the ongoing expansion of our active customer base and the strong RPAC levels we continue to achieve. Our total credit portfolio also experienced robust growth in the fourth quarter of 2024, increasing 45% year over year and 13% quarter over quarter, both on an FX-neutral basis, reaching a total of $20.7 billion. This strong performance was driven by growth across both lending and cards. During the quarter, our credit card portfolio maintained its upward trajectory, supported by further expansion in the shares of wallets across all customer segments. This portfolio expanded 28% year over year and 9% sequentially on an FX-neutral basis to reach $14.6 billion. Meanwhile, our lending portfolio more than doubled during the year to $6.1 billion, a 22% sequential gain, also on an FX-neutral basis. Lending continued outpacing credit cards, reaching 29% of our total portfolio. Consistent with previous quarters, our lending cohorts demonstrate strong credit performance, enabling us to further scale originations. This growth is driven not just by increasing customer eligibility, but also by gradually expanding ticket sizes and loan durations, which remain a fraction of industry averages. This approach underscores our significant growth potential, but also reflects our ability to navigate challenging environments with agility and resilience, as we have demonstrated during previous economic downturns in Latin America. Now, let's look at a breakdown of our credit card portfolio. Interest-earning installments continue growing quarter over quarter. However, this growth was overshadowed by strong seasonal expansion in non-interest earnings balance, bringing the share of interest-earning installments down to 27% of the overall credit card portfolio. Please note that this outcome aligns with the expectations that we shared last quarter, following the intentional deceleration of Pix financing for specific risk bands. Although demand for Pix financing products and their profitability remain very strong, we have deliberately tempered the pace of eligibility expansions during the second half of 2024 to carefully monitor the performance in the coming quarters and to assess what we call the second-order effects of this product on customer engagement and the long-term value of customer relationships. Now, at the beginning of 2025, after a more extensive testing and adjustments, we began refining our Pix financing offer for different risk bands, taking into account customers' potential exposure to this product to mitigate any undesirable effects on asset quality or engagement across our platform. Given this approach, and especially in a more challenging macroeconomic environment, we do not anticipate a significant expansion of Pix financing penetration, at least in the short term. Let's move to our lending business. Originations surged 84% year-over-year to 18.4 billion reais in the quarter. Unsecured lending remained the primary growth engine, originating 15.6 billion reais and demonstrating our success in fostering financial inclusion for both individuals and SMEs in Brazil. Now, our secure lending originations reached 2.8 billion reais in the fourth quarter of 2024, representing 15% of our total lending originations. Notably, these originations are 100% in-house, generated exclusively through our platform, and do not include portfolios acquired from third parties. Equally exciting is the strong performance of FGTS-backed loans, which expanded to over 60% of our total secure lending originations. News market shares of new originations in this product has already surpassed 30%, reflecting the strong market fit of our fully digital distribution channel. This year, we also made significant progress towards achieving product parity, and we are pleased with the early performance indicators of new features for public payroll loans in Brazil, such as portability, top-ups, and refinancings. Additionally, we successfully integrated and launched operations with Brazil's armed forces, a very key milestone in expanding eligibility. To further grow our total addressable market, or TAM, we have signed new collateral agreements, now totaling 11, including partnerships with several major Brazilian states and municipalities. These agreements will allow us to reach over 70% of the TAM for public payroll loans in Brazil in the coming months, expanding access for newly eligible customers and supporting continued growth in originations. On the funding side, our total deposits for the quarter increased to $28.9 billion, up 55% year-over-year on an FX-neutral basis. This growth was supported by robust expansion across our three geographies. In Brazil, deposits reached $23.1 billion, an 11% sequential increase on an FX-neutral basis. Additionally, our deposit rate strategy in Mexico and Colombia continued to yield excellent results. It has significantly increased deposits in both countries, furthering our mission to empower our customers to take control of their financial lives, while also adding financial resilience and strong liquidity buffers to our operations in these countries. Even after reducing the spread over the interbank rate, our operations in Mexico accumulated $4.5 billion in deposits, a fourfold increase from 2023, highlighting our ability to enhance cross-selling opportunities while still improving unit economics. Lastly, our performance in Colombia exceeded our expectations. Deposits reached $1.3 billion, just 2 quarters after launching Nu Colombia's checking account and placing us among the country's top 5 financial institutions based on demand deposits for individuals. Net interest income rose significantly, increasing 57% year over year and 9% sequentially on an FX neutral basis, reaching a record high of $1.7 billion. Conversely, our net interest margin contracted 70 basis points to 17.7% this quarter. This was primarily driven by the very same factors that we highlighted last quarter. First, lower credit yields, reflecting ongoing shifts in both product mix due to the increasing share of secure loans and customer mix, as we continue testing price elasticity in line with our improving risk profile. Second, funding costs also increased as a result of stronger deposit growth in Mexico and Colombia, and consistent with our deposits rate strategy in these new geographies, which are still remunerating deposits at a premium to the benchmark rates. Additionally, FX movements once again negatively impacted our NIM, as the FX rate used to translate the numerator depreciated more than the FX rate applied to the average interest earning assets of the denominator. Now, looking ahead to the mid and long-term profiles, we remain confident that the balance sheet optimization will be the primary driver of future NIMs, especially as deposits normalizations in Mexico and Colombia take place. Regardless of interest rate trends, we see significant opportunity to expand originations by shifting funds from cash to credit. With our loan-to-deposit ratio still at significant low levels, we believe there's a lot of room to improve efficiency and further strengthen our profitability levels. Now, let's turn to the last pillar of our strategy, maintaining a low cost to serve. We continue to believe that our platform is one of the most cost competitive in our markets and represents a significant competitive advantage. Accordingly, we remain committed to keeping our cost at or below $1 per active customer for the foreseeable future. Once again, we achieved this goal with a cost to serve per active customer of 80 cents of the dollar. On an FX neutral basis, this represents an 11% year-over-year increase, largely due to seasonal spikes in data and processing usages. Simultaneously, our RPAC grew by 23% over the same period, highlighting the strong operating leverage of our business model. Our gross profit reached $1.4 billion this quarter, an 8% sequential increase and a 44% increase from 2023, both on an FX neutral basis. Gross profit margins stood at 45.6%, returning closer to 2023 levels, despite higher funding costs we expected in our new geos. This performance also reflects the strength of our business model, which continues to deliver significant profitability even as we expand and invest in new markets. Over the past quarter, we continue demonstrating our ability to drive operating leverage as our business scales. Our efficiency ratio improved significantly, closing the quarter at 29.9%, and 150 basis points improvements from the previous quarter, and over 610 basis points better than last year. This progress underscores the strength of our low-cost operating model, which enables us to sustain strong growth and drive product innovation while maintaining efficiency. With ongoing investments in technology and automation, we remain confident in our ability to further optimize our platform as we continue to scale. Net income in the fourth quarter reached $553 million, up 7% sequentially and 85% year-over-year on an FX neutral basis, while our net income margins expanded 300 basis points to 18%. Additionally, adjusted net income for the quarter increased by an impressive 87% from 2023 levels to $610 million. Our strong bottom line results further demonstrate the effectiveness of our strategy and the resilience of our business model. While we are pleased with our fourth quarter performance, our focus remains on maximizing the long-term value of both our customer relationships and our company. This approach entails making deliberate short-term investments to unlock future growth opportunities, enhance customer engagement, and reinforce our leadership positions in the markets where we serve. Now, I'll hand the call over to Youssef, our President and Chief Operating Officer, to discuss asset quality and the overall health of our credit portfolio.
Thanks, Lago. Hi, everyone. Starting as usual with NPL trends. Our leading indicator, the 15 to 90 ratio, declined sequentially by 30 basis points to 4.1% in the quarter. Beyond the normal seasonal decrease we see in early delinquencies in the fourth quarter, this improvement was driven by mix shifts, one, towards lower risk customers in credit card, and two, towards lower risk products, given the growing mix of secured lending within our portfolio. 90 plus NPLs decreased by 20 basis points to 7.0%. And as a result of past trends in 15 to 90, which have been decreasing for 3 quarters in a row now. Those decreases in 15 to 90 are now showing up in the 90 plus ratio, which, as we've mentioned in past calls, behaves as a lagged stock indicator of long-dated delinquencies. This next slide highlights asset quality trends for both 15 to 90 and 90 plus NPLs, but this time on the basis of interest earning balances rather than total receivables in the denominator. As you can see, the trends have remained stable to declining in recent years, reflecting the strength of our credit underwriting and portfolio management capabilities. This demonstrates that we are being rewarded for the additional risk we've taken, reinforcing our strategic focus on maximizing the lifetime value of customer relationships rather than solely optimizing delinquency metrics over the short term. Let's now turn to our renegotiated portfolio for an update on key trends. Renegotiations have remained relatively stable over the past year, with the majority of their volume occurring before 15 days overdue, as a result of our low-friction, proactive approach to this customer experience. This helps customers reorganize their finances early, lowering the risk of delinquency while minimizing the impact on NPLs. And as shown on the right-hand chart, we maintain a robust provision coverage level of more than 200% over 90-plus balances of our renegotiated portfolio, underscoring our prudent risk management and focus on resilience across our credit operations. In line with the growth of our credit portfolio, credit loss allowance expenses increased by 12% sequentially on an FX-neutral basis, reaching $804 million this quarter. In turn, risk-adjusted NIM compressed by 60 basis points in the quarter, driven by the 70 basis point decline in NIM explained by Lago earlier, partially offset by a 10 basis point improvement in cost of risk. To conclude this section, we are sharing an analysis conducted with one of our data providers, which compares the performance of our credit card portfolio to that of the Brazilian market. The 6 charts on this slide show 90-plus NPL time series segmented by risk band, where the purple and the gray line the rest of the industry. As you can see, across every segment, the portfolio consistently outperforms the industry, resulting in lower delinquency rates within a risk band. This reflects the strength of our credit underwriting capabilities, which are based on a more precise risk assessment of each customer and the sloping of credit limits to make them more appropriate to each individual customer alongside other factors, such as achieving a higher share of principality, meaning that more customers use Nu as their primary financial institution, which further enhances usage and repayment behavior and strengthens overall portfolio performance. With that, let me now turn the call back to David. David, go ahead, please.
Thanks, Youssef. As we look ahead, we remain in the early stages of leading a profound transformation in financial services, both in Latin America and globally. Although we have maintained a remarkable growth trajectory since founding Nu, Today, we only capture a fraction of financial services revenue worldwide, which reinforces our belief in the vast opportunity still ahead of us. Our strategy continues to prioritize responsible and ambitious growth over short-term earnings gains, and we see 2025 as another pivotal year of investment, during which we will deepen our presence in Brazil, Mexico, and Colombia, expand our product portfolio, and lay the groundwork for our long-term ambitions. With this in mind, I'd like to outline our 2025 priorities through what we call our three-act story. Starting with Act 1, building the largest and most loved retail banking franchise in Latin America. This is our focus today and where the majority of our resources, time, and focus remain allocated. While we have achieved significant scale, our market share still represents less than 4% in revenue terms, only a fraction of its full potential. In this growth phase, we will continue nurturing customer love, scaling our credit operations, and increasing principality in Brazil, Mexico, and Colombia, all while delivering a seamless, fast, and globally reliable app experience. Moving to Act 2, expand beyond financial services. We embarked on this journey a few years ago with our entry into the marketplace, travel, and more recently, telecom verticals. With a large and highly engaged customer base, one of the most loved and trusted brands in Brazil, and significant data and cross-sell capabilities, we believe we have earned the right to go beyond traditional financial services. Our goal is to create an ecosystem that broadens our addressable market and empowers customers to optimize their spending. Building upon the engagement and needs of our customers, we believe this strategy will enable the launch of new verticals in the future. And finally, Act 3, a global AI-driven digital banking model. This is our long-term vision. We endeavor to evolve our regional digital banking platform into a global model, leveraging artificial intelligence to provide hundreds of millions of customers with access to financial products and services that have historically been reserved for a select few. In 2025, we will take critical steps to turn this vision into reality by building the necessary foundations to support our products and services at a global scale. As our three-act story unfolds, our unwavering focus remains on execution, customer-centric innovation, and sustainable growth. We have built a technology platform with the potential to truly redefine financial services across Latin America and beyond, and we're more than excited than ever about what lies ahead as we develop our platform to thrive in this new asset class. Thank you for your continued support, and we look forward to another year of progress and positive impact. With that, we're now ready to address your questions.
We will now start the Q&A session for investors and analysts. If you wish to ask a question, please press the reaction button and then click on Raise Your Hand. If your question is answered, you can exit the QE by clicking on Put Your Hand Down. Please limit yourself to one question and a follow-up. If you have further questions, please re-enter the QE. You may submit online questions at any time today using the Q&A box on the webcast. I would like to turn the call over to Mr. Jörg Friedemann, Investor Relations Officer.
Thank you, operator. Could you please open the line for Jorge Kuri at Morgan Stanley?
Hi, everyone. Congrats on the numbers. Thanks for the opportunity to ask questions. I wanted to ask about a comment that Lago made earlier regarding PIX. Can you just clarify what not expanding PIX in the short term means? Is this not expanding it as a percentage of the portfolio, or is it actually not expanding it in absolute balances so that it will, shrink, I guess, as a percentage of your total credit card portfolio? Thank you.
Hi, Jorge, this is Lago. Thanks for your question. So what I meant is that we should not grow PIX financing as a percentage of the overall portfolio, not in absolute terms. So yes, overall, PIX financing should continue to expand, but more in line with the overall expansion of our credit card portfolio in Brazil in the very short term. So as we mentioned in the prior call, we basically reduced the eligibility growth of PIX financing for the lowest kind of credit bands of PIX financing, primarily to address what we saw, some deteriorations in second orders impacts related primarily to NPS, churn, and engagement. And here it's important to highlight that the overall profitability and resilience of the PIX financing portfolio continues to be remarkably positive, but we wanted to improve the way that the customer is being presented and the customer journey so as to minimize or even eliminate any potential negative second order impact. We have been working with our teams over the course of the past months in such improvements. We now have about 12 tests in the market to improve the journey of the customers. We are seeing some encouraging results, and I'm encouraged to believe that we will be able to resume growth in percentage terms over the coming quarters. But I don't want to create any expectations that this resumption of growth will happen necessarily in the next 1 or 2 quarters.
And Jorge,
Great,
here,
thank
let me add one point here related to this, because I think it's a good opportunity to understand, even go back to culture. This is a great example of a product that is very profitable, and we've shown profitability, and that if we were optimizing for short-term profitability, we would continue growing significantly. But here we have a choice to make, which is prioritizing short-term earnings over improving in some ways the user experience. And as we've always said, we're optimizing for the long run, we're optimizing for long-term consumer love, and we're just not happy necessarily with the secondary order effects on NPS. So we rather take it slower, continue improving the user experience, the user interface, the long-term NPS of the consumer, and accelerate the growth once we are very comfortable with that. And I just think it's a good example of what improving and optimizing long-term NPS means, even though it might cost us a bit on the short-term earnings per se.
Thank you. That's very clear. If I may add a follow-on, because I'm guessing PIX has had an impact on your NIM and risk-adjusted NIM. Is it possible for you guys to help us understand the different moving parts on risk-adjusted NIM, for example? I mean, Lago, you talked about the funding cost increase in Mexico and Colombia, the temporary increase in funding costs in Mexico and Colombia because you're growing the business had a negative impact on your NIM. Taking on more risk type clients, and then the FX portion. Can you sort of like walk us through the bridge of what each of these items has had the impact on, say your risk-adjusted NIM, which is now 9.5%, and it was 11% 2 quarters ago. So that 150 basis point, more or less, how does it break out between the different components?
No, great question, Jorge. So in the fourth quarter of 2024, our NIM dropped by about 70 basis points, and you can probably see this in let me get here the right numbers, but you can probably see this in one of the slides that we have presented in the earnings. Out of those 70 bips drop that we saw, I would say that the most relevant factors were, number one, the FX, right? So the FX, we use different FX rates when we translate the local currency into dollars, the denominator and the numerator. So the numerator is usually employing kind of average FX. The denominator is typically translated implying end of period FX. And the use of those different FX rates explains about 45% of the 70 basis points contraction. The remaining 55% of the contraction is largely equally explained by 2 things. Number one, the drop in yields in the overall credit portfolio in Brazil as we grow secure lending more than we grow unsecured lending in terms of loan balance. And 2, as a result of the growing deposits in Mexico and Colombia, which are still paying kind of interests that are higher than the interbank deposit rates. So those are the three things, Jorge, that I believe justify the contraction of the NIM. Now, if we move to risk-adjusted net interest margins, you do have the same kind of 70 basis points to which I alluded before. And then you have positive 10 basis points on cost of risk performing slightly better than expected. Going forward, how do we see this? And so certainly there are a lot of moving parts with respect to product mix, with respect to Brazil versus our international geos, but we continue to believe that the most relevant outlook for NIMs and risk-adjusted NIMs is the optimization of the balance sheet. We continue to have a loan-to-deposit ratio that is below 40%. As our loan book grows and we shift part of our liquidity from treasury bonds to credit portfolio, we do expect to see NIMs expanding in the medium term.
Thank you, Lago. That was exactly what I was looking for. And thank you, David, as well.
And our next question comes from the line of Eduardo Rosman from BTG Pactual.
Hi, everyone. I have a question here regarding one of your slides. I think it's slide 26. I think Youssef, you show how Nubank has been performing better than peers in credit cards underwriting. Right, so I think that the low and growth strategy, the principality, kind of explains, part of that, But what about unsecured personal loans, right? Which is where you've been kind of accelerating at the margin, right? Do you believe you can achieve, the same level of outperformance as you did in credit cards? Is that a different product? How we should think about it? Should we think about, them combined? So if you could help us understand, it would be helpful. Thanks.
Hi, Hosman. This is Youssef. Yeah, thanks for the question. You're right. So even though the analysis we presented here on page 26 applies to credit cards, I expect the same dynamics to be playing out in unsecured loans as well. It's just in credit cards, it's a little bit cleaner as an analysis to do because you can identify those loans with a little bit more precision than unsecured loans. Typically, unsecured loans tend to be packaged with other types of partially secured or other types of collateral that would show up in various data sources that are hard to kind of parse out. But I would say, the ability to do low and grow in unsecured lending would show up in the form of very small tickets in the beginning for new customers or customers that don't have a proven track record of repayment. Then over time, we get repeat usage. When we get repeat usage and we have more performance data, we can actually increase the amount of loan exposure that we give out to a customer to be able to borrow. And likewise, the more data we have, the more precise our risk assessment can be. So like all those dynamics are applicable to unsecured lending as well. And we believe that credit underwriting expands to that product class equally.
Oh, great. Thanks.
And our next question comes from the line of Tito Labarta from Goldman Sachs.
Hi, good evening. Thank you for the call and taking my question. I get my question on the secured lending. You mentioned here, 1.4 billion in secured loans. So you seem to, much bigger than kind of we had thought. I think it's the first time you disclosed this, and you continue to grow the originations there. I just want to understand how do you think about the growth, the continued growth of that, both from FGTS and payroll loans. Now that I think on the payroll loan side, you have signed several agreements, you have the portability. Do you think this growth should accelerate even faster? Also, particularly in a year where macro is a little bit more challenging in Brazil, do you think this can really be a big driver of growth and profitability for the rest of the year? Just help us maybe contextualize the growth or the opportunity set of the secured lending portfolio.
No, Tito, thanks so much for your question. And we couldn't be more excited with the growth of our secure lending portfolio. and both kind of the direct P&L and unit economics that it brings, but also the strategic relevance of growing in an asset class that has proven to have a relatively good correlation with principality for our customers. But let me try to break down my responses in a few. So within the secure lending portfolio today, we basically have three asset classes. We have public payroll loans, we have FGTS, and we have investment-backed loans. So public payroll loans, we have over the course of the last 12, 15 months, been basically improving products and features, focused primarily on the two major collateral lines, namely INSS and SIAPI. By the end of 2024, I believe that we have reached what we call product parity with the market. So our customers today can do first loans, can do refinancing, can do top up with portability. So we do expect that just relying on those two main collateral agreements, which account together for more than 50% of the target market, we will see an acceleration of our originations and loan portfolio throughout 2025. Now, in addition to INSS and SIAPI, we have now signed over 9 or 10 new collateral agreements, including with the Brazilian Armed Forces and the largest states and municipalities of the country, which should only add fuel to the fire. And in fact, in January 2025, we have seen historical high originations for public payroll loans and secure lending in general. So we are excited with that, with the prospects of public payroll loans, secure lending. Now, going to the second asset class, FGTS, that has been what we believe to be a fairly successful entry strategy into a new product. We estimate that we already account for more than 30% of the originations of FGTS financing in Brazil, which we see with no positive lens for two reasons. First, it is a very profitable, very resilient asset class in itself, but also it showcases how successful a direct-to-consumer, fully digital distribution channel can play out in Brazil. And we hope to take the learnings that we have accumulated with FGTS into public payroll loans. And then finally, the third asset class, which is investment-backed loans, which accounts for, give it or take, 10-15% of our total originations. And we'll continue to expand in line with the expansion of our customer base and asset class. So those three asset classes are what we consider to be today our secured lending, and we think it will only pick up throughout 2025. It is also timely, Tito, to highlight the prospects of private consignado, which you have been writing about and many other people have been talking about, which is a completely new asset class that may be formed in Brazil, even though technically this asset class already exists today. The changes and improvements that are expected to be brought to the market can really unleash the growth of a new form of consumer credit in the country. And it will not only be able to increase the size of the pie of consumer credit in Brazil, but also materially improve the terms and conditions of credits to Brazilian consumers. So we have been working very closely with the Brazilian government, with other industry participants, and we believe that this could be a very good opportunity for our customer base and for Nubank to continue to expand its share of wallet.
Great, that's very helpful, Lago. If I can just to follow up, just to think about the profitability of the payroll, because it's a more secured product and yields are much lower, and we were seeing risk-adjusted NIMs coming down. But I imagine you also have, as you mentioned, you have a lot of capital. You can leverage up the balance sheet. So how do we think about profitability of payroll loans relative to the profitability of credit cards, personal loans, and sort of where the bank is today?
So you are absolutely right, Chito. So the profitability, if you measure this on a ROE, the ROE of the secure lending asset class is in fact lower than the ROE of the unsecured lending and lower than the ROE of credit cards. However, I would not agree with the assertion that the growth in secure lending is expected to dilute our overall ROE. Why do I say so? Because we will not be growing secure lending at the expense of credit cards or at the expense of unsecured lending. We will basically be putting to work the excess of liquidity and the excess of capital that we have in the balance sheet. So if I were to illustrate this more simplistically, we are basically shifting part of our treasury bond portfolio in Brazil to fund our secure lending business, which in itself has much bigger NIMs and risk-adjusted NIMs for us. So it does have lower ROIs or lower ROEs, but it should not be dilutive to the overall level of profitability of the company. On the contrary, it should help us kind of optimize balance sheet deployment and overall profitability levels for the company. Not to mention, Tito, the fact that it is an important product to foster additional primary banking relationship, additional engagement, which in itself will bring kind of lots of long-term benefits to the relationship of Nubank with our now over 110 million customers in Brazil.
That's very clear. Thank you, Lago.
And our next question comes from the line of Thiago Batista from UBS. Thiago, your line is open.
Can you hear me?
Yes, we can.
Okay. I have one question about the credit card business, especially in Brazil. When we look for the numbers and your market share by segment, seems that Nu is approaching to a kind of maturation of this product in the country. Do you agree with this view that there is not a lot of room to expand in the credit card business in Brazil? And just as a follow-up on this point, we saw this quarter a contraction in the NII of credit card. Do you have this was caused by the PIX financing, or there's no other explanation for this contraction in the NII of the credit card business?
So thanks for the question. Let me try to get the reduction in the NII or in the yield of credit card, and then I'll let Jag or Youssef comment on our credit card penetration across the segments and the growth opportunities that we continue to have within this product in Brazil. So generally, what you will see is that what we call credit card yield over the past 2 or 3 quarters has decreased in Brazil. That has been largely a function of 2 things. So as we continue to grow our shares in our more affluent customers, namely what we call UV or ultraviolet, we operate with lower price points when we enter more affluent customers. And as the growth of more affluent customers through UV has outpaced the growth of less affluent customers and therefore has gained relevance in our overall portfolio, it has contributed to a slight contraction in the credit card yield. The second thing, which is more related, Thiago, to the last 2 quarters, since the beginning of the second half of 2024, as we identify the second order impacts of PIX financing, and we reduce the expansion of eligibility in these customers, that also has created some headwinds for credit card yield. But overall, this is a product that continues to generate very healthy ROEs and very healthy levels of credit resilience, which we are very happy to continue expanding.
Yeah. Lago, let me comment on the question from Thiago. Thiago, I think the short answer is we still see significant room for growth in credit card in Brazil. I'll go through it sort of step by step. First of all, in the typical mass market customer that we've historically served, you will note that we've made efforts to re-engage customers who were previously inactive and made some progress on that. That is an ongoing effort. And we have a portfolio of initiatives against that through last year and into this year. And we expect incremental progress in continuing to have improvements in customers' activity and purchase volume, etc. There are also significant opportunities, we believe, over the medium term to grow into other segments where we've historically not played as much. I'll point out two of them. First is the high-income customer segment, where over the course of 2024, we have well over doubled the number of Ultravioleta customers, and also doubled our purchase volume from Ultravioleta credit cards, as we've worked to significantly improve that product. We've also started to get some very good early traction for small business customers, so-called PJs, in the credit card product. So steadily over the medium term and beyond, we expect that there's significant room to grow in our credit card product just in Brazil, where, as you will know, we've only had today about 14% market share, as indicated by purchase volume, and so we don't think we're anywhere near the frontier of what is possible with the business model. There's more room for growth in the mass market, even though our shares are higher there, and there are many new segments which we've been laying the groundwork for several years, and in particular in 2024.
Very clear, Lago and Jago.
And our next question comes from the line of Gustavo Schroden from Citi.
Hi, good evening, everybody. Thanks for the opportunity. My question is regarding the credit cycle. We've seen some signals of a potential deterioration in inflation for foods, and we know that there is a high correlation between inflation and asset quality, also an environment of high interest rates, and some questions about the macroeconomic environment. And then we've seen, the system or most of banks that we talk to adopting a more conservative approach on the credit concession. And I can see that according to this call and your words, we can see that Nu is still, I would say, relatively positive in terms of credit growth. Of course, excluding the Pix Finance, as I explained, that you need to redesign the product. But on the other products, we can see you still positive on the pace of growth. I'd like to understand what's the difference here, and if you do not have concerns about potential adverse selection in this environment. Thank you.
Hi, Gustavo. This is Yusuf. Thanks for the question. Listen, I wouldn't say that we're not concerned about macro. In fact, just as a reminder, in the way we underwrite credit in good and bad times, we're always very concerned about adverse effects from macro factors, external factors, and just kind of generally unknown factors. And so this is why we always say that when we underwrite a loan or a credit card or any form of credit, we expect the future to be significantly worse than the past, right? Those are the assumptions that we put in our models to underwrite. They always have a significant stress from a forward-looking perspective, and we've adhered to that philosophy, throughout. This is not the first time that we face or we're facing a negative outlook with respect to Brazil macro in particular, and not only that, it's a matter of outlook. We've actually gone through severe recessions throughout our 10+ year history. So we have both a battle-tested portfolio and a battle-tested kind of underwriting framework around that. So we try not to time the market with a lot of precision, because we don't think we have a better crystal ball than anyone in terms of forecasting short-term, what happens to macro, what happens to asset quality. And so we prefer to take a very conservative approach and assume that the future is going to be worse than the past at all times. And we've learned that, in terms of our ability to withstand, negative parts of the cycle, the decisions we make in good times, when the macro is favorable, tend to drive our performance of the portfolio in bad times. And so, we think we've underwritten a portfolio throughout the cycles that is very resilient, that can withstand, over twice the amount of risk that we've observed and still be profitable and above hurdle from an NPV perspective. And so we continue to underwrite with that level of caution, built into the system. In addition to that, we're not blind to the fact that the forecast has worsened in Brazil. And so when we do not just underwriting, but when we do allowance and provisioning, we do reflect, a slightly worsened forecast in terms of how much we provisioned. So those are some of the ways we think about that, and we remain really confident in our ability to continue to underwrite and continue to grow, in both good and bad parts of the cycle as we have in the past.
Okay, very clear. Thank you, Youssef.
And our next question comes from the line of Mario Pierri from Bank of America.
Hi, good evening, everybody. Thanks for taking my question. I wanted to ask the question to Davi. On your last slide, you talked about building the critical, taking the critical steps to build a global franchise or global scale this year. I wanted to hear a little bit more. What does this mean in terms of investments and costs? In exactly what is the plan? Are we talking about here then which markets are you looking to enter? Are you most excited about potential US franchise or expanding in Southeast Asia, Africa, or other countries in Latin America? So again, if you can give us a little bit more, what are you thinking about becoming this global digital bank? And also, what does this mean in terms of expenses in 25? Thank you.
Sure, happy to. So going back a bit to where we started the business, the basic hypothesis of Nubank since 2013 is that the digital banking model that we are growing is the right business model to bank 80-90% of the world population. 20, 30, 40 years from now, we're not going to be seeing people going to a banking branch. It's going to be much more of an exception than a rule. And we think about the past 10 years in Brazil, Mexico, and Colombia as having been able to prove that hypothesis, at least in the first market, which is Brazil. I think what we can show when we show our Brazilian business today, we can prove that this is a model that, number one, can reach more people and can include more people into financial services, can do it with a higher quality, with a higher net promoter score, can do it with a much lower cost, and also with a higher profitability. It's a superior business model because it makes every stakeholder better: consumers, investors, and employees. So, and Mexico and Colombia is going in the same direction. I think we're very good. We're very happy so far with the result that we've seen so far, and it's following very similar paths to Brazil, even though the markets are differently in a number of different ways. So, in a way, we think about the first 10, 11 years of Nubank history of proving the hypothesis in this core banking market in Latin America. Then the question is, how do we go for the next 10 years? And I think over the next 10 years, we'll continue to go after that hypothesis of testing this model really in more countries beyond Latin America. There are a number of complexities to do that. This is not an easy model to internationalize, especially the way we do it, which is we want to become the primary bank account of our customers. We're not just a wallet. We don't want to be just a wallet where you leave some cash to do some payments or some remittances. We want to be the primary bank account of customers. We think that's the most valuable strategic positioning in banking. Because of all the advantages that brings. And to be primary bank account, we have to go very deep in these markets. We have to get banking licenses. We have to get connected with a number of different local parties. So therefore, it has been a relatively slow internationalization. A big part of that speed of that internationalization has to do with our technology platform. Nobody in history, as far as we can tell globally, had no other global bank, global consumer retail bank, has been able to build a multi-country platform that is extremely efficient, that has one code base, that ultimately could give them a significant advantage in expanding. And that's what we've actually been building this already for about 18 months and probably have another 18 to 24 months. And is something that will continue maybe forever. having a core bank, proprietary core banking platform that allows us to be in multiple countries, that allows us to launch new countries with relatively low investment. So getting specifically to your question, what this really means is we're continuing to build this technology platform and this technology infrastructure through 2025. It's not going to be a meaningful expense change versus what we already have been investing. We've mentioned last year that 30 to 40% of our employees today are building products that are generating no revenue. So we're investing significantly for these next 10 years of evolution already. That is true for 2023. That is true for 2024. Will be true for 2025. Won't be a significant change versus what you've seen in 2024. And once we pick a country or countries, we're going to always do it in a way where it's more of a call option approach, where we start slowly, we invest little money up front, and as we get confidence and conviction about markets, we're going to continue to invest significantly. That's what we did Mexico. That's what we did Brazil. We launched Brazil with $1 million. We launched Mexico with about the same. So you won't expect us doing big bang approaches in new big markets. We'll take a much more careful approach, testing the hypotheses at every angle, trying to leverage our own technology and our own capabilities, and do it in a way where if we find this significant upside, we'll invest much more on that. So long answer to your question, which is effectively don't expect any meaningful changes in expenses. That's already embedded in the type of expense and investment that we've already been doing for a few years.
Okay, no, that's clear. But when we think about it, right, like I think you mentioned that today you only have 4% market share of the profit pool or of the revenue pool of the countries where you are operating. It feels like, right, it still is, you are still at the very, very early stage in the current countries. Like, wouldn't it be more, I guess, wouldn't it make more sense first to continue to grow in these countries and make sure, right, that you get the strategy right, especially in Mexico? It feels like you're going in the right direction, but yeah, it will probably take a few more years before you become profitable, and it's a very competitive market, right? The Brazilian market is also evolving. We've seen competitors ever since you entered the market, they're adapting, right? So my main concern is, okay, I get 30 to 40% of employees are working on projects that don't generate revenues today, but what about senior management, like the distraction, right? Like that you are gonna have when you try to become like a global franchise. So again, sorry for the question, but it feels like maybe a little bit too early, that maybe you should be bigger in your existing countries before you start thinking globally.
No, I think it's a phenomenal question, and I think you're right, and you're actually saying exactly what we're saying, which is the focus. And if you listen, if you go back a bit to what I said initially, the overwhelming focus of management and the company remains on what we called Act One. So Act One, which is Brazil, Mexico, and Colombia, continue to have over 90% of all the focus of the company. We think this is the highest priority. We think Mexico is a huge opportunity. We're excited about what the secure lending opportunity, Brazil, the 4% revenue market share that you mentioned in Latin America. It's tiny. There is a lot that we can do increasing the revenue share, especially in the 3 countries that we operate, which account for 60% of the entire revenue share of Latin America. So as you and I are aligned. The point, though, is right now for internationalization specifically, getting ready is a multi-year effort. And so it is prudent to start investing 1-2% of our capacity to be ready to do that in a few years with much more investment of resources and energy. So we cannot do this fully sequentially. You got to do a little parallel execution there. 90% plus goes into core. Even the 40% metric of employees investing in stuff that don't generate revenue, they are associated with Act Two, which is going financial services, and that is associated with the markets that we are today. But for internationalization specifically, today is a tiny percentage of our capacity that is going into figuring out that next phase of growth that we have ahead.
All right. Now it's clear. Thank you very much.
Thank you. Great question.
And our next question comes from the line of John Coffey from Barclays.
Great. Well, thank you very much for taking my question. I saw that your principality is now at, I think, 61% of your active customers, so up from 60% last quarter. I know this is probably going to be a challenging question to answer, but can you give me any kind of high-level way of thinking about what these, 1-point increases in principality, what that could mean to the P&L and the model in general? Any, again, views on what we should see if you went to 62%, all other things being equal, what that impact would be on revenue, margins, net income?
Yeah, John, thanks so much for your question. Look, I think I wouldn't necessarily get too focused on principality going up by 1% or down 1%. There is some seasonality effects there, especially given how we measure principality, especially in the fourth quarter of the year. There's a higher concentration on purchase volumes and transactions that may kind of bring principality a little bit up and then eventually a little bit down. But I think if I step back and try to address your question, the primary banking relationship metric for us, which is a metric that we have been evolving over time, is one of the most important operational KPIs for the company, because we do believe that primary banking relationship is one of the holy grails of digital bankings globally. Why do we say so? Because the RPAC of a primary banking relationship customer is now 3 to 4 times higher than the RPAC of a non-primary banking relationship customer. The delinquency of a primary banking relationship customer is 48% lower than the delinquency of a non-primary banking relationship customer on an apples to apples basis. And so this is the way that our model has been construed. As Davi mentioned, we are not envisioning to be kind of the secondary wallet or an FX play. We often mention that we are not in the business of collecting social security numbers. We are in the business of becoming the primary banking relationship of our customers. And in a world, especially in Brazil, in which open banking or open finance is expected to unfold positively over the coming quarters, we think it is going to even increase the relevance of becoming the primary banking relationship of our customers. So it's not only a long-term strategic angle, it's also a very short-term kind of P&L boost, and this is one of our primary kind of North Stars.
Thank you. One quick follow-up. On your LDR, which dipped from 40 to 39%, I was wondering if you could think a little bit about what the bottleneck is here of why that wouldn't get to maybe 45 in the near term. Would you say most of this is Mexico, which you have a big deposit base, but maybe you're still battle testing the credit model a little bit, in that you're not really ready to deploy more of that capital immediately, or is it something else?
No, I think, look, let me address 2 points on this good question, John. So first, when you look at any financial institution with an LDR of 39%, I think the first question that one may ask is, look, why don't you drop the deposit rates that you're paying, or why don't you increase the loan book that you have in order to optimize the balance sheet? I think the first approach is, we do believe, as we mentioned before, that we want to be the primary banking relationship of most of our customers. And in order to achieve that, we do need to be the place where they make payments, receive payments, store value, and therefore having a very relevant deposit franchise is very strategic for us, not only from a primary banking relationship perspective, not only from a funding perspective, but also from a data acquisition perspective. So we do not see necessarily having a low LDR as a sign of weakness of the model. On the contrary, it should be seen as a way that we are getting more and more customers' principality and engagement through our platform. Now, of course, we do aim and we would love to be able to grow our credit book faster and faster over time. in order to kind of optimize the balance sheet. But we also have to be fairly responsible that scaling credit books, specifically unsecured credit books, it's something that you have to do with a very systematic credit underwriting discipline, and you cannot necessarily double or triple your credit book just because you got more deposits. You need to do so carefully and with the right level of credit resilience and thoughtfulness that we believe we have been doing over the past years. So that's, I think, the disconnect that we have been seeing over the past quarters. The growth in deposits in Mexico and Colombia over the past 2 quarters have certainly contributed to lowering our loan-to-deposit ratio. But in both countries, mainly in Mexico, we are very confident that 2025 will see a very pronounced ramp up in the velocity with which we grow the loan book there. Every single credit metric that we observe in Mexico is performing as per our expectation or even slightly better than expected. And that will kind of lay the groundwork for us to continue to improve the balance sheet in each of those geos.
Thank you very much.
And our next question comes from the line of Yuri Fernandez, JP Morgan.
Good evening, everyone, and thanks for the opportunity of asking questions. I would like to ask about unsecured personal loans, if you can provide some more color on the strategy for this product, especially in Brazil. Very good origination. It's the product growing the fastest that you have, like more than secured lending. That is a less mature product, right? When we look to the number of clients, it is growing, but it's growing a little bit less than the balance. So my question here is, like, where is the growth coming from, right? Is this a higher duration strategy? Are you going to new customers? Is this linked to the lower loan yield we are seeing? So if you can provide a little bit of color. And just a question also related to this product. This is usually a higher risk product for most of the time. And we do see you being more selective on fixed finance, but not in this product, right? So why somewhat different approach between fixed finance and unsecured personal loans? Thank you.
Yuri, thanks for the question. This is Jag. I'll try to answer your questions in order. First of all, I would mention to your last point that credit quality has been getting stronger in lending, and we look product line by product line at all of the trends, the first order credit trends, second order customer impacts, etc., and make those decisions in a very granular way. So that basically describes, why we are making the decisions we are making in lending, and why they might be different in PIX financing or other products. Let me zoom out though and talk more broadly about our unsecured lending strategy. And as you've noted, we've seen very, very healthy growth over the quarter and over 2024 as a whole. There are a couple of hallmarks to what we've been doing that's been driving those results. First, we've significantly increased the mix of unsecured personal loans that are going to customers who've already taken a first loan with Nubank. And as a result, we understand and have vetted the risk dynamics. So an increasing mix of our personal loan portfolio, our second loans are loans to active customers versus, in earlier years when the business was much less mature and much less scaled, we were offering loans to customers for the first time. So now we're offering loans to customers who we vetted, who have either finished paying a loan or are on course to do so in a very healthy way, and we have greater confidence. That helps a second dimension of our success, although it's only a part of it, which is that we've been able to do two things simultaneously across our lending portfolio, which are the following. Adjusted for risk, and that matters, but adjusted for risk, for any given level of risk, we have been able to offer larger loans, and we've been able to offer lower interest rates, better pricing to our customers over the course of 2024 through, as I mentioned, getting to know our customers better from a personal lending perspective, and also through significant investments in credit modeling, which have yielded really significant results, and we expect that to continue through this year as well. And the third thing I would mention is that, similar to what I talked about in credit card, where the bulk of our book was in the mass market historically, we are now starting to expand personal lending and adjust the product to be a better fit for new segments. And again, I'll mention the same two segments I mentioned when we talked about credit card: high income and small businesses. And in high income, for example, those customers require significantly larger max principals. They expect lower pricing given their lower credit risk on average. And that required significant testing on our part over the last 12 plus months. But as we've gone through that cycle of testing and experimentation, we're now able to provide that to a much better degree, and we're seeing good response from our high-income customers. Similar dynamic on the small business side. So those are the key things that explain the significant success we've had in 2024 and in Q4 on unsecured lending.
No, super clear, Jack. If I may follow up, just on duration, are you changing the strategy on duration? Are you able to, with this, more comfortable approach on the lending book? I remember it used to be around 6 months, the average duration for this product. Are you able to increase this? Like, how are you seeing like the term of the loans here?
Yeah, Yuri, that's a great question. I apologize for missing it on the first go around. It's a great question. What I would say is we are working to increase duration as makes sense for our customers, and we are optimistic that we will be able to incrementally increase duration over time, relatively slowly. But moving in that direction of longer durations. We have several efforts that are in, I would say, the relatively early stages of testing to move things in that direction. So yes, I would expect to go in that direction, but I wouldn't expect that to be dramatic or rapid in terms of that trajectory.
No, great. Thank you very much.
Thank you, everyone. We are approaching 90 minutes of the call, so I will have to end the session. So we are now concluding today's call. On behalf of Nu Holdings and our investor relations team, I want to thank you very much for your time and participation in our earnings call today. We are very excited for developments into.
Let's just really quickly, because I'm not going to recap it all right now. Obviously, there's a lot to talk about, but this is Nubank doing Nubank things. Here, let me lower you guys. You're all the way up there. This is Nubank doing Nubank things. Okay, I think that this is not something to worry about. The market can have their fuss because obviously they're looking at it just purely fundamentally, and there is some contraction because obviously the dollars that they're trying to take in and account for on a US dollar basis is, seeing massive headwind there. But the macro there versus the United States dollar will sway both back and forth. Okay. So like they said during the earnings call, they will have years or many, many years of really strong tailwinds and then really strong headwinds because they're dealing in multiple or in a different geography than even what they're reporting in. That being said, as they go more global, a lot of those FX headwinds actually start to get a little bit neutralized, or at least just not focused to large extremes. So that could even mean that while the Brazilian real is really high and they have a larger base in Colombia and Mexico, that they actually don't see as great of benefits than whenever they were exclusively in Brazil. But that's actually better. It takes away some of the volatility and allows the volatility to be had in the actual success of the business, in which, the speed in which they grow is the volatility. And so I'm very, very excited about Nubank. This call reinvigorated all my love for the company, but this is why I didn't buy. At least the why I didn't buy after the main sell-off is that what was going to happen in this quarter was going to be some statistics that analysts were not going to be happy with because there was massive FX headwinds. But some of the statistics that they showed off of growing in ultraviolet customers or small to mid-sized enterprises or the growth in secured personal loans. I mean, there is a massive market share in Latin America that is just seemingly at the take for them. And Brazil, Mexico, and Colombia in itself will have some general problems in short periods of time. In longer periods of time, you're actually seeing, better GDP per capita, better life expectancy there, better, growth in digitalization for, longer term tailwinds. But in the short term, they are going to face some hard comps versus last year. Okay. I loved their 2025 priorities. Okay, so building on what they already are doing, expanding beyond financial services, which I'm super excited about because the prioritization that they had last year was to really hyper focus on Mexico, in which they did that dramatically. They grew customer accounts there all the way up to 10 million users. Expanded getting into different products in Mexico. But if you're saying expand beyond financial services, I don't think that they just mean, new sell or their marketplace products. I think we're going to see many new non-financial services products that not only add to their revenue base, add to the stickiness of the customers, improve the primary banking relationships of the customers, but also de-risk from some of just the pure credit-only plays and goes towards more of an exact replication of what SoFi is trying to do of bringing on more fee-based revenue services. So loving this. There's legitimately no cap to their growth potential. Everything that they're saying in terms of being a tech-focused, globally growing, they are following the Robinhood playbook, actually ahead of Robinhood, but following in that same degree with a SoFi-focused mindset. The only difference is that it's from a different geography, and they're going to have some problems there. But I'm going to take these problems as potential medium term. We're talking 3 years of potential headwinds for them, all while trying to grow their actual business underneath. Fundamentally, this is Coinbase or any of these crypto companies in crypto winters. The building doesn't stop, okay? And actually, a lot of the headwinds that people are facing internally in those companies are not potentially even as felt as much as whenever you're comparing them to United States GAAP-based metrics. So I think that it's important to look at the key performance indicators that they're focusing on. Focus on customer counts. Focus on the product cross-sell. Focus on the primary banking relationships, which we actually got some great detail there from Davi Velez that said, the RPAC for primary banking user is 4 times higher and the delinquency is nearly 50% lower. It's just insane. And they're now at 61% of their active user base is now a primary banking relationship, and they want to do the exact same thing in Mexico and Colombia. They're not a wallet. They are a primary banking solution for everyone. I'm going to continue to hold this company with legitimately zero concern going to bed at night worried about this business. I mean, this company is doing what Nubank does, and the market can have their fit, whatever, about foreign exchange. And then those analysts that are saying, there's a potential pullback in this area will be the exact same ones that bump up their price target 4x from where it is today, years down the line, saying how strong this company is and how much it's benefiting from its mixture away from, just being in one country or just in the United States. And by the way, they will be in the United States, and watch during times of really strong macro headwinds, how hard that they push into, areas like the United States. You're already seeing it in crypto. They're pushing US dollar, like stable coins like USDC on their members insanely hard. Now it's a very small percentage of their business. I mean, very, very, very small. But the businesses or the people that they're actually getting on those businesses are actually FX neutral. So it's very, very exciting where they have to go. And I just don't see any cap to that. And I have seen no reason why a Brazilian, client, customer, whatever, would ever want to switch away from Nubank. And they're not going anywhere. So those are the things that I want to focus on. Okay. Ladies and gentlemen, thank you all so much for watching. I really do appreciate your time. But I'm going to get going. Bye for now.